You think AARP makes its money on membership dues. $20 a year, maybe $15 if you let it auto-renew. A card in the mail, a magazine. A sticker for your suitcase, a discount at the hotel desk. With more than 38 million members, you do the math in your head and figure the dues add up to real money. They do add up. They are just not where the money is. AARP collects roughly 4 times as much from putting its name on other companies' products as it does from every member who carries the card. The dues are almost a footnote next to the royalties. Here's how it looks from the outside. AARP is the giant advocacy group for Americans over 50. You join, you pay your small annual fee, and in return you get the magazine, the bulletin, the discounts, and a voice in Washington. Multiply a low double-digit fee by tens of millions of members, and the obvious story writes itself. The members pay the dues fund the organization fights for older Americans. A simple membership club, run at enormous scale, paid for by the people in it. That is the picture almost everyone has. And part of it is true. AARP really does have more than 38 million members, and it really does collect dues from them. In fiscal 2023, membership dues brought in about $289 million. That is a serious sum. If dues were the whole story, this would be a healthy mid-sized nonprofit living off its members, and the math would be tidy: members in, advocacy out, but dues were not the whole story. They were not even most of the story. Set that $289 million down on the table, and look at the line sitting right above it, and consider how cheap that fee is by design. The standard rate is around $20 a year, and it drops to about $15 for the first year if you commit to automatic renewal. Think about what that buys. For the price of a couple of lunches, you get a magazine with one of the largest print circulations in the entire country, a steady stream of discounts on hotels and rental cars and prescriptions, and the sense that a powerful organization is fighting on your behalf in Washington. No business prices a flagship product that low if that product is how it pays the bills. The dues are not priced to fund AARP, they are priced to grow it. Keep that idea in your pocket, because it is the key to the whole thing. So where does the money really come from? Royalties. In that same fiscal year, AARP reported about $1.1 billion in royalty revenue. Stop on those two numbers together. $1.1 billion in royalties, against $289 million in dues. The royalties are close to 4 times everything the membership pays combined. AARP's total revenue that year was around $1.7 billion, and royalties alone made up roughly 2/3 of it. The dues you pay are real, but they are the smaller piece of a much larger machine. And this is not some strange one-year fluke. Go back a year. In fiscal 2022, AARP's total revenue was about $1.8 billion, and royalties were again about $1.1 billion of it, while dues sat far below. 2 years running, the same shape. Royalties on top, dues well underneath. This is the steady state of the organization, not an accident of timing. The card in your wallet is not the product. Your trust in the card is the product. And someone else is paying for it. Here is what a royalty actually is in this case, because the word does a lot of quiet work. AARP does not sell you insurance. It is not an insurance company, and it is not licensed to sell policies. What it does is license its name. A commercial company, an insurer, a financial firm, a travel brand, pays AARP for the right to put the AARP name on a product and market that product to AARP's members. That payment is the royalty. The single biggest of these arrangements, by far, is in health insurance. On AARP-branded Medicare supplement policies, the ones people call Medigap, AARP receives 4.95% of the premium as its royalty, according to court filings. Every single month the member pays that premium, a slice of it flows to AARP for the use of its name. Nearly 4.5 million people are covered under those AARP-branded Medigap plans. And of AARP's roughly $1 billion in royalties back in 2020, around $752 million came from health products and services alone. Health is not a sideline, health is the engine. Put that 4.95% in plain terms. On a Medigap premium of, say, $200 a month, that is close to $10 flowing to AARP every month just for the name on the policy. Spread that across 4.5 million covered people, paying every month, year after year, and you can see how the royalties climb into the hundreds of millions without AARP ever selling a single policy itself. And notice what the percentage is charged against. It is not a flat licensing fee. It is a slice of the premium itself, which means AARP's cut grows automatically as premiums rise and as more members enroll. The royalty rides on top of the insurance, scaling with it. That is why a single category, health, could throw off around $752 million of AARP's roughly $1 billion in royalties in 2020, the largest single category by far. The dues are a fixed $20 that never moves. The royalty is a percentage that compounds. Stack a flat fee against a growing percentage across tens of millions of people, and the gap between them is not an accident. It is arithmetic. So why does this work, and why can't just anyone do it? Because the whole engine runs on one thing that took decades to build: the trust of millions of older Americans. An insurer can sell a Medicare plan on its own, in a crowded market, fighting for attention. But a Medicare plan with the AARP name on it reaches a member who already believes AARP is on their side. That endorsement shortcuts the entire sale, and companies pay enormous sums for it. Now think about what that royalty costs AARP to earn. Almost nothing. AARP does not underwrite the policy. It does not pay the claims. It does not run the call center, price the risk, or process the paperwork. The insurance company does all of that, and carries all of that risk on its own books. AARP lends its name and its mailing list. And in return it takes a percentage off the top. So $1 of royalty is far closer to pure margin than $1 of dues. The dues have to pay for the magazine, the staff, the advocacy, the programs that members actually consume. The royalty arrives with almost none of that attached. The name is the asset. The 38 million members are simply what makes the name worth renting. And just how much is the name worth? In 2024, the scale of it spilled into public view. AARP restructured and extended its long-running deal with United Healthcare, the insurer behind the AARP-branded health plans, locking it in for another 12 years. Instead of collecting royalties month by month, AARP took one fixed payment up front. That payment was just over $9 billion, according to reporting on AARP's own financial statements. $9 billion. Most of it booked as deferred revenue, to be recognized across the years of the deal, with about $8.7 billion still sitting on the balance sheet at year-end. That is not a typo, and it is not the dues. It is the price of one insurer's right to keep wrapping its product in the AARP name. Set that one payment against AARP's revenue for the year, and a single insurer accounts for something close to half of everything the organization took in. One partner, one name, nearly half the money. And look closely at the structure of that deal, because it tells you exactly how the brand licensing engine works. AARP did not sell anything new. It did not take on a single new policyholder or write a single new plan. It simply extended one company's permission to keep using its name for another 12 years, and converted a stream of monthly royalty checks into one fixed payment recognized over time. Think about what that swap reveals. A monthly royalty rises and falls with how the product sells. A locked, upfront sum says both sides expect the name to keep performing for over a decade, and were willing to put a price on that certainty. The brand was treated like an asset with a measurable future value, the way an oil field or a patent might be. That is the licensing engine in its purest form. AARP owns a name that millions of older Americans trust, and renting that name for a fixed span is worth more than most insurers earn from selling the actual coverage. This is the loop, and once you see it, you can't unsee it. The cheap dues keep the membership base enormous and the brand visible everywhere. A huge, loyal, visible membership is exactly what makes the AARP endorsement valuable. And that valuable endorsement is precisely what the royalties pay for. So AARP does not need to make money on you directly, because the real customer is not you. The real customer is the company that wants to reach you. You are not the buyer, you are the audience being licensed. And that is a genuinely delicate position, because the same trust that makes the royalties valuable is the very trust AARP exists to protect. Critics have raised exactly this tension. They have asked whether an organization that earns a percentage of insurance premiums can also be a fully neutral advocate on insurance. And some have gone to court arguing the Medigap royalty amounts to an unlicensed commission. Federal judges have consistently dismissed those cases, generally finding that regulators approved the rates, or that buyers showed no real harm, with at least one case under appeal. And AARP's own position is clear and on the record. It says these fees are used for the general purposes of the organization and fund its mission, that the products are vetted, and that its policy work is kept separate from its business interests. The arrangements are disclosed year after year in its public filings. We are not here to settle that debate, And we are not accusing anyone of anything. We are here to show you the flow of money. And the flow is plain. The name earns several times what the members do. It is not only health insurance, either. The exact same licensing model runs across AARP's whole catalog. There are AARP branded auto and home insurance products, life insurance, travel and roadside services, prescription discount programs, and financial products. Each one is another company paying to wrap its offering in the AARP name and set it in front of AARP's members. The mechanism is identical every single time. AARP is not the seller. It is the brand on the box collecting a fee for the use of the box. Health is just the largest box in the warehouse. And look at the rest of AARP's revenue, because the same shape repeats right down the page. In 2023, beyond the royalties and the dues, AARP took in roughly $100 million or so in investment income, and over $100 million more in publication and advertising revenue. The advertisers, just like the insurers, are paying to reach the same audience. Almost every major line of AARP's income, except the dues themselves, is somebody paying for access to the members. The membership is not the revenue. The membership is the inventory, and now the cheap dues finally make sense. A paying member is a committed member, a verified name on a list. A person who has raised their hand and said, in effect, I am over 50 and I trust this brand. That list, that scale, that trust, is exactly what a royalty partner is buying. So the $20 fee was never priced to fund AARP. It is priced low precisely to keep the membership gigantic, because the bigger and more loyal the membership, the more every endorsement is worth, and the bigger every royalty check becomes. The cheap dues are not the business, they are what makes the business possible. The fee is the bait. The trust is the catch. So here's what AARP really is. Not a club funded by its members, but a brand that rents its trust to the companies that want to sell to its members, with the dues kept deliberately low to keep that brand as large as possible. It is a nonprofit. It discloses all of this in its public filings, and it says the money funds its mission. None of that is in dispute. What's surprising is simply the direction of the money. You assumed it flowed from you up. Most of it flows from the companies that want you in. And once you see that shape, you start spotting it in every membership you hold. The organization in front of you may not be living on your fee at all. It may be living on the value of your attention and your trust, sold quietly to someone you never meet in the transaction. The thing you pay for is rarely the thing that pays them. Next time we follow the points, the airline that earns more selling miles to a bank than it does flying anyone anywhere. The money was never in the seat.